What's going on, everybody? This is Joey from Universal CPA Review. While the CPA exam is primarily going to test your ability to determine the various tax calculations related to entity taxation, hint, hint, the entity's initial formation, various taxation rules, and both non-liquidating and liquidating distribution calculations for all three of the major entities, something else that the business law content area likes to test is some of the more conceptual related information respective to each entity. So in this video, we're going to attack the specific information related to all of these entity types. So don't forget to subscribe to our YouTube channel and join any of our Facebook study groups. And if you think that you're more of a visual learner and think video explanations for every single multiple choice question is something that would help you prepare for your CPA exam, try Universal CPA Review for free. We offer a 14-day trial, and if you think it could possibly be the difference between passing and failing, you can commit to our program and obtain lifetime access to any of our course products. And if you do want to commit, feel free to apply discount code UNIVERSAL2021 at the checkout to obtain 25% off any of our course products. Okay, here we go. Think of business structures as the conceptual part of entity taxation. Okay, so the exam is going to lump business structures within the business law content area. But the reality is that everything we're going to be talking about is related to what we discussed within entity taxation, right? You remember C corporations, S corporations, and partnerships. Yeah, only the most heavily weighted portion of this exam. Okay, so a lot of students feel that this is a miscellaneous topic within business law, and it's often ignored. Do I blame candidates for ignoring this section? No. Am I going to be held accountable for not teaching this to its fullest extent? Also no. Okay, because the reality is you need to know all of the details to ensure your highest chance of getting these questions right. Okay, so let's dig into it. At the end of the day, there's a lot of verbiage that's going to be thrown your way here, but we're going to simplify this. Okay, so there are 4 real steps to business structures. Okay, and although saying the word memorize is like saying the word Voldemort to the folks over at Hogwarts, right, the word memorize should never be in our vocabulary, we are inevitably going to be doing a little bit of memorizing for this topic. So again, 4 steps to business structures. We have entity formation and entity termination, right? Basically, when it comes to formation, we want to know which entities require filing with the state and some additional miscellaneous rules that might be applied. And when it comes to entity termination, we just want to know how to dissociate or dissolve any of these entities. Okay, so I know we talked a little bit about formation and entity termination from a tax perspective, which yes, is still going to be the most important thing to note, at least when it comes to formation and termination related topics for this exam. And when I say from a tax perspective, I mean we were calculating the shareholders basis, the partners basis upon the initial formation of the corporation or partnership. We were learning how to calculate all those gains and losses from liquidating a corporation or a partnership. Right, you remember all that good stuff. This entity formation and termination stuff, however, is going to focus in on the little nuances, right, the details for each type of entity. Okay, so on top of that, we also need to know the little details about what the blueprint refers to as non-tax related features and characteristics. All right, so that's just gibberish for how these entities are going to be managed and operated. All right, and another sneaky topic related to this that might show up on the exam is an understanding of various rights, duties, and legal obligations and authority. In other words, who is liable if this is a general partnership versus a limited liability partnership? What if this is an LLC? Okay, so at a high level, this is what we are going to be focusing in on. So let's fire it up by talking about entity formation. And it makes sense that we start here because this is the beginning of the entity's life. Now, the meat and potatoes of entity formation on exam day is going to come down to being able to calculate basis and any gains that result from the formation. Okay, but they might sneak a question in there that has to do with specific types of entities and what is required for them to be formed. Okay, so this is how we're going to do it. We're going to go down the line and compare the rules for each entity instead of attacking these one entity at a time. Okay, at the end of the day, it's going to be about seeing a question on the exam and being able to differentiate the rules for one entity from another, right? If you're scanning a question, you want to avoid sitting there thinking to yourself, oof, I know this, but what are the rules for general partnerships versus limited liability partnerships, right? That's just an example. Okay, so we have 8 types of business structures that we're going to talk about. So again, starting by talking about formation, and let's start by talking about the formation of a sole proprietorship. Okay, so sole proprietorships are when one person is starting a business, right? They're the founders of the company. They're keeping things simple by simply filing a Schedule C on their individual tax return. Okay, but point being is that there's no separation between the owner of the business and the entity itself. And when it comes to the formation of a sole proprietorship, there's no necessary formal filing for the business in order to be formed. Okay, so sole proprietorships are always going to be the simplest form of entities, right? Partnerships are a little bit more comprehensive, right? So you might be sitting there thinking, but Joe, you already know all the rules for forming a partnership. Okay, and while the calculations remain the same during the initial formation, there are several different types of partnerships that have different rules, okay, at least when it comes to actually forming the partnerships and incorporating in the real world. So the two most similar types of partnerships are what's referred to as a general partnership and a joint venture. Okay, so the rules for forming these partnerships are exactly the same. And when I say that, I mean that they could be formed by either a contract, which can either be made verbally or in writing, or they can be formed simply by the partners implying that the partnership exists by their conduct. So essentially what that means is they're going to show up to work every single day, they operate as normal partners, and voila, the IRS considers that proof that this is a partnership. Okay, so if it walks like a duck, it talks like a duck, then it's probably going to be a duck. Okay, but one thing that these two partnerships will not require is filing with the state. So if these are very similar, what is the difference between the two? Well, a general partnership is a normal business, right? This is you and your colleagues leaving your public accounting job and starting your very own CPA accounting firm. This is your college roommate and yourself starting a t-shirt company, right? In other words, this is your ordinary business. Whereas a joint venture is set up for a very specific purpose. And when I say a specific purpose, even more specifically, these are generally set up for one specific transaction. Okay, so what's a good example of this? You and I decide we're going to team up and construct a real estate development, right? We want to buy this land and build a multifamily home and sell it to some real estate investors. Okay, but point being is that the whole purpose of setting up this joint venture was for one specific transaction. Okay, boom. That's the real only difference between the two. Okay, but what you need to remember when it comes to formation of these three entities that we just talked about, right, sole proprietorships, general partnerships, and joint ventures, is that these are the only three entities that do not require filing formal documentation with the state. All right, so what do we have next on our list? Next, let's talk about limited liability partnerships. This is also known as an LLP. Okay, so if those previous three entities that we just talked about are the only three entities that do not require a formal filing with the state, then what does that tell us about limited liability partnerships? These will require that the entity files a certificate of limited liability partnership with the state in order for it to legally start operating as a business. Okay, so one of the key differences to LLPs, and we'll talk about this a little bit later, is that this is going to limit partner liability. All right, but we're talking about formation, not yet talking about rights and obligations. Okay, so in order to file an LLP, the entity is going to file a certificate of limited liability partnership. Okay, so they're going to file with the state. All right, and this is generally going to include the business's name, the address of the business, the names and contact information for the partners, the registered agent's contact information if there was one, and other administrative details. All right, so this is very similar to limited partnerships in that they also must file certificates with the state. Okay, so that certificate's going to be extremely similar. The only difference here when it comes to the actual entity itself is that there's going to be one general partner and one limited partner. All right, so limited liability corporations must also file articles of organizations with the state, right? This is the formal documentation. Same concept, just different context to the actual document. All right, so we want to know the LLC's name, the name and address of the registered agent, how it will be managed, and the names of the owners to the LLC. Okay, and once again, corporations, we have two types of corporations. We have C corporations and we have S corporations. Okay, so the relevant calculations to forming these entities are nearly identical. All right, and the actual filing with the state is also going to be nearly identical. The only difference is, as we remember, we are going to start by filing a corporation, which will generally be a C corporation, but in order to be an S corporation, the company must also elect S status. Okay, so C corporations are going to be double taxed as separate entities, whereas S corporations will be treated as a pass-through entity. Okay, so just to recap our clues to success when it comes to formation, zero your attention in on who is going to be filing with the state. All right, at the end of the day, the shorter list is going to be those who are not filing with the state. So if you're going to be memorizing, I know the big bad memorizing word, start with sole proprietorship, general partnership, and joint venture. Those are the only entities that will not be required to file with the state when incorporating. So now let's talk about the termination of each respective business entity. And we said that the meat and potatoes of entity taxation is always going to be the calculations related to entity's basis, or any gains or losses calculated from the dissolution or liquidation of a given entity. So once again, we're going to go down the line and talk about the rules for each of these entities as far as their termination goes. Okay, so starting again with sole proprietorships. Sole proprietors are able to sell or transfer their ownership in the business at any point, right? Remember, this is the most simple type of business entity. Okay, so there are no specific rules or restrictions that will inhibit or prevent the proprietorship from terminating. All right, if they want out, they can get out pretty easily. Okay, but now digging into partnerships, and there's a little bit more detail here yet again. So some terms that you might hear when it comes to termination might consist of dissolution and dissociation. So what's the difference between the two? So let's define the two. Dissociation is the disconnection or separation of something or something else, or the state of being disconnected. Okay, so tying that back to the materials, this is going to occur when one partner ceases to be involved in the business, right? They are disassociating themselves from the entity. Whereas dissolution, as the definition suggests, is the closing down or dismissal of an assembly, partnership, or official body. So if we were dissolving a partnership, this would be winding up the business, right? In other words, this is going to terminate. Okay, but keep in mind, dissociation does not necessarily cause dissolution. If one partner wants out, the business can continue. Okay, so again, general partnerships and joint ventures are very similar in nature. Forming both of these types of partnerships will require the same process. Same goes for terminating them. So consent is going to be required from all parties for partners to either dissociate from the partnership or for the partnership to dissolve. Okay, so some reasons that you might see on the exam for one partner to dissociate from the partnership can include a partner dying, partners becoming bankrupt, or additional specific reasons agreed upon in the partnership contract. Whereas dissolution, once again, will be when the business is over. And this can occur when one partner decides they want out entirely, right? In which case they might need to restructure the partnership in order to continue. Okay, so we're going to skip down to if there's a court order. So if there's a court order for the business to dissolve, then it will dissolve. Okay, but there is a caveat to the death of a partner. This is generally going to be optional. All right, so if a partner dies, the business can still continue if the deceased partner is bought out. Okay, so let's be familiar with the dissociation and dissolution rules for both general partnerships and joint ventures. Okay, those are going to be the same. All right, so next up we have limited liability partnerships. Okay, so a limited liability partnership agreement can prevent dissolution if a partner dies or withdraws. So this is similar to the rules that we saw for general partnerships. Okay, so LLPs can be dissolved if there's an agreement of the partners. If one partner dies, but remember, once again, this is not going to be required that it dissolves if one partner dies. It's going to be optional. Or if there is a withdrawal of one partner. Okay, but again, if one partner dissociates or withdraws, not going to be required that there is a dissolution. Okay, so how about the termination or dissolution of limited partnerships? These are LPs. Okay, so we remember that limited partnerships will have a general partner and a limited partner. So in this case, if a partner dies or withdraws from the partnership, then it will dissolve, but only if that partner is the general partner. Okay, so if the general partner dies or withdraws from the partnership, then the entity will dissolve. Not the limited partner though, right? If the passive investor dies, then the partnership is not necessarily going to dissolve. Okay, so some additional reasons for the limited partnership to dissolve: if there is unanimous consent of all partners, or if there is a lapse in time in the agreement. Okay, limited liability companies. These will dissolve upon the death, retirement, or bankruptcy of a member, with the exception of members voting as a group to continue business operations. Okay, so focusing in on the word member. When it comes to limited liability companies, LLCs will refer to their people as members. Not partners, not shareholders, not stockholders. They're called members. Okay, so if one of the members dies or retires or goes bankrupt, then all of the members in the LLC must vote to continue the business in order for it to continue. Okay, so another reason for dissolution of an LLC would be if there's unanimous consent of all members, or once again, if there's a lapse in time in the agreement. Okay, so all of this is going to be a little bit different from corporations. Okay, so dissolution of a corporation will require management and shareholder approval. Okay, so we're talking about both C corporations and those S corporations. So once this termination process begins, the company will begin to liquidate. Okay, and before the dissolution begins, the company should pay back any associated debt, expenses, and distribute all assets that are required to creditors and shareholders. So when it comes to corporations, some reasons for dissolution can include bankruptcy, if the majority of the shareholders agreed to dissolve it, or again, if there's a court order. All right, and again, we're talking about these dissolution rules for both C corporations and S corporations. Okay, shaken and bacon, progress is being made, people. We are now in the third step of our mental map, and we're talking about some non-tax operational and non-tax related features and characteristics related to these entities. Okay, so in other words, we want to know how each of these businesses are going to be managed and operated. So firing this up again with sole proprietorships, keep in mind this is a business, but this is a business that is operated by one person. So it's only going to exist as long as the sole proprietor is alive. Okay, so if the proprietor dies, then this proprietorship would no longer exist. All right, so this is your independent contractor. So let's think about Becky, who goes to people's houses and does blowout hairstyling. Right, let's say she goes over to their houses and she always does a great job, right? Everybody's like, "Yas, queen." Okay, so Becky gets paid in cash and there's no formal filing. This is Becky running this sort of informal business operation, right? But keep in mind, if Becky dies, this business will no longer exist. But if she decides for whatever reason to sell off her book of clients to Stacy, then she could transfer her interest. Okay, but at the end of the day, when it comes to the management of this business, sole proprietors can manage this business by themselves. Alrighty, so again, digging into partnerships now, and starting with general partnerships and joint ventures, and really also this is going to include the same rules more or less for limited liability partnerships. Alright, we want to know how these guys are being managed. So the general assumption is that unless there is something that stipulates exactly how the business is managed, right? In other words, unless the operating agreement delegates roles and responsibilities specifically, then it could generally be assumed that all partners will have equal rights to manage the partnership. All right, so they could do this however they want. But also keep in mind that management's rights and their voting power will not be associated with the amount of money that they contributed to the partnership. Okay, so let's say, for example, now that Becky, Stacy, and Rhonda now want to scale their company and set up their very own hair studio. Let's say that Becky contributed 30% of the capital, Stacy contributed 30% herself, and both of them are going to be the ones cutting hair. But let's also say that Rhonda is more of a passive partner, right? She manages the company's finances, but she also owns 40% at the end of the day. Okay, so that's the portion that she contributed. When it comes to voting rights, it doesn't matter. They're all going to have 33.33% voting rights. And again, that's going to be if this is a general partnership, it could be a joint venture, or even a limited liability partnership. Okay, so that's the key takeaway. They're all going to have the same voting rights, regardless of the prorated portion of the capital contributed. Okay, so at the end of the day, equal rights to manage the partnership however they want, regardless of the capital contributed. So it would require some combination of either these two ladies' votes for them to legally make ordinary business decisions. Okay, and key word there is ordinary, right? That's going to be things like Stacy wanting to buy more shampoo. That's the studio supplies. In other words, every partner will have the right to act as an agent to the company, meaning they have the apparent authority. Why does that sound familiar? Because we talked about apparent authority when we talked about this in agency contracts under business law, right? Come on, you remember that. What if it's not ordinary though? What does that even mean? Well, what about a decision to bring in new partners? What about deciding to sell the business? Who has the voting rights to make these decisions? Okay, so notice these are not ordinary business decisions. So in this case, all of the partners must consent. Okay, so in other words, Becky, Stacy, and Rhonda must all decide unanimously to agree to this as a team. Okay, that sounds fair to me. And that's going to be the case even if it's a general partnership or a joint venture. This could also be the case if this is a limited liability partnership. Okay, while the majority of rules associated with general partnerships and limited liability partnerships are slightly different, we're going to have the same operating rules when it comes to these two entities. All right, but limited partnerships, on the other hand, is where things change just a hair. Okay, limited partnerships, as we said, will contain at least one general partner and one limited partner. So in other words, at least one person will be running the day-to-day, and that's the general partner, where at least one partner will also be a limited partner. Okay, so these are your passive investors, and they're going to operate very similar to shareholders in a corporation, meaning they don't actually run the business. They just sort of sit on the sidelines and wait for their return. Okay, so let's now say that instead of teaming up with Stacy and Rhonda, Becky raises some additional funding from Hair Capital. Okay, so they invest in everything hair related. All right, I know that's absurd. Let's say that Becky raises $100,000 for 30% interest in her company. All right, but Hair Capital has nothing to do with the day-to-day operations. That makes them these passive investors and also known as limited partners. Okay, whereas, as we said, the general partner would be those that are operating the day-to-day. All right, so Becky would own the other 70% and would be the primary operator and the general partner. Okay, so what's the deal with limited liability companies? These are similar to sole proprietorships in that most state jurisdictions permit one person to form an LLC. Okay, but keep in mind, this is an entity in itself, whereas sole proprietorships are not going to be separate entities from that person. Okay, but with that said, there are some major differences in these two entities, obviously, okay? And one of the major differences is the concept of limited liability. All right, but we'll talk about that in just a little bit. Just know that one person for now is required to form an LLC. Okay, so just because it's one person doesn't mean that it can't be more than one person. So that means that if there's more than one person, right, let's say again that Becky, Stacy, and Rhonda have teamed up to form this hair studio. Okay, only this time they incorporated as an LLC. How is this going to work from a management standpoint? Well, similar to an LLP and even a general partnership, all partners will have the right to participate in managing the LLC. Right? There's not a general partner versus a limited partner, right? All that crap that we would see in a limited partnership. Okay, so as we said, when you think about LLCs, you're thinking about the term members, who are also known as owners. Okay, but there's also what's referred to as managers. So we have to ask ourselves, is this a member-managed LLC or is this a manager-managed LLC? Okay, so those words might seem very similar. So if you're memorizing words, this could be a little bit tricky. So let's focus on what those words actually mean. Okay, so member-managed LLCs are going to be when the individual member is considered an agent of the LLC, right? Meaning, like we learned in agency contracts, is that they have the right to bind the company to certain obligations. Whereas if this is a manager-managed LLC, then the member, who, by the way, is the owner of the business, hires a manager, right? Let's say now that Becky, Stacy, and Rhonda hire Jeff to manage their barbershop spin-off company, which was formed as an LLC. Okay, so in this case, they are completely passive to the business and not managing it. So in this case, they will not be able to act as agents or have the power to bind the company to its obligations in the way that Jeff would. Okay, so I know that might feel like a detail, but let's back pocket that one. Now, where LLCs are different from general partnerships and LLPs is that they're not all going to have the same amount of voting rights. So this is going to be based on capital contributions now. Okay, so if the same situation as before presented itself, Becky, Stacy, and Rhonda form an LLC at 30%, 30%, and 40% ownership respectively. Then Becky's voting rights would be 30%, Stacy's voting rights would be 30%, and Rhonda's would be 40%. Alrighty, so managing and operating a corporation is pretty straightforward as well. Something to keep in mind is that unlike partnerships, corporations aren't going to have agents necessarily in the way that partners might act as an agent on behalf of the partnership. Corporations will have what's referred to as promoters. So promoters are separate parties that do primarily work related to the formation of the company. Okay, so this is going to be things like promotion and incorporation and solicit people to invest in the company. Okay, and typically that's all going to happen when the business is being formed. All right, now finally for step 4 in our mental map, we're going to think about the rights, duties, and legal obligations or authorities of owners or management given in a specific scenario. And we're going to start once again with our first scenario, which is that of a sole proprietorship. Okay, so when it comes to legal obligations, you're thinking who is liable? Okay, so if Becky accidentally lights her client's hair on fire, who's going to end up being liable for that mistake? So the rule here is that proprietors will be the only ones assuming the liability. So if you operate the business alone, you're likely going to be the only one that is responsible. Okay, so that's what you got to know. So we previously mentioned the voting rights to general partnerships and joint ventures in previous lectures. But there is a situation where partners can assign their interest, and that is if the partnership's interest is assigned by one partner to another partner. Okay, so if the partnership's interest is assigned, the assignee, right, the person who receives that interest, will have the right to receive the partner's share of profits. Okay, but that doesn't necessarily make them a partner. It just entitles them to profits, meaning they will not have the ability to participate in ordinary business decisions. Okay, so in addition to that, each partner will have a fiduciary duty to other partners. Okay, so they're going to have to act in the best interest of the partnership, and they should act in the best interest of other partners. Right? Remember, the partners are all agents to the partnership. Okay, so who is liable in a general partnership and a joint venture? Okay, so when we compare general partnerships to limited liability partnerships, this feels very similar. But one of the key differences is that limited liability partnerships are going to limit the partner's personal liability in the partnership, whereas a general partnership is going to hold each partner personally liable for all partnership obligations. Okay, so what does that mean? Well, it means if Becky, Stacy, and Rhonda started this partnership to run their hair studio, and they borrow a boatload of money and default on that debt, that means that each of Becky, Stacy, and Rhonda are going to be personally liable for paying back the debt, right? Not just the partnership. Okay, so that means that they can come after their personal liabilities if this is a general partnership or even a joint venture. But if it's a limited liability partnership, one of the advantages is that the creditor cannot come after the limited liability partner's personal assets. Okay, so something sneaky to note is even dissociated partners can be held liable for debts that the partnership owes. Okay, and although this is a small detail, they may be liable for up to 2 years after their dissociation. Okay, so it's not for an infinite amount of time that they're still bound to this company, right? That's the whole point of disassociating, right? Maybe they want nothing to do with it anymore, but the government says that they have 2 years to wait it out. Okay, so this is generally the reason why limited liability partnerships, right, those LLPs, will exist. Okay, so this is going to be when Becky, Stacy, and Rhonda file with the state to open their hair studio in the Bronx, right? They're saying, hey, New York, we talked to our legal counsel and we want to be an LLP because we don't want to be personally liable in case Becky drops the ball and sets Kathy's hair on fire again. We don't want to have to pay for that mistake. Okay, so again, that's the major difference in a limited liability partnership from a general partnership. Everything else is pretty much identical. Okay, so the only major difference is partners will not be personally liable for the debts and obligations of the partnership under an LLP. All right, that doesn't mean that the partnership in itself is not going to be liable. Okay, so although Kathy can't go after Becky, Stacy, or Rhonda's personal assets, she could certainly still sue the partnership itself. Okay, so that was an LLP. Let's remove an L. Let's talk about limited partnerships. So when you're thinking about limited partnerships, you're thinking about what? You're first going to be thinking about the fact that there's always at least one general partner and at least one limited partner. Okay, that's the common theme. So now we're thinking about liabilities related to this partnership. You've got to disassociate general partners and limited partners in your head. They're independent from one another. And the reason is because you could think of the general partner once again as the operator of this business, right? You remember Hair Capital investing in Becky's hair studio, right? Hair Capital is the limited partner, whereas Becky is the general partner. So an advantage to Hair Capital is that only the general partner would assume personal liability in the event that the limited partnership incurs debt that cannot be paid back. Okay, so while Becky solely acts as the agent to the partnership, she's also going to be the one that remains personally liable for all partnership debts if this is a limited partnership. Okay, so if there are losses, only general partners can be held personally liable. All right, so limited partners are not going to be held personally liable, regardless of whether they participate in management decisions or not when filing a limited partnership. Okay, so if we have a limited partnership, the limited partner will limit their liability. Okay, so what about limited liability companies? This is an interesting hybrid because although it has company in its name, you might be thinking of this as a type of corporation, not a partnership. But it can also be treated as a partnership for tax purposes, right? In other words, it can be treated as a flow-through entity and wouldn't necessarily be subject to double tax as if it was a C corporation, for example. But we can remember that S corps are also going to be flow-through entities. But when it comes to limited liability companies, members, which you remember are owners, will be able to limit their personal liability in the same way that shareholders would in a corporation, right? Meaning the members will not be held personally liable for the obligations of the business, just like limited partners will not be subject to personal liability in an LLP. Okay, and finally, let's talk about some of the rights, duties, and obligations of corporations. When it comes to corporations, we're primarily going to focus your attention on rights that shareholders will have, in the same way that we focused on rights to members in an LLC and partners in a partnership. Okay, so we have shareholders to this corporation, and they're generally not going to be involved in the operating business activities. They're also naturally going to have limited liability, right? If you invest in Tesla stock and Tesla fails to pay back its obligations, the creditors aren't going to go after your personal assets, right? You would just lose some money on the stock's value. So there are ultimately three parties in this hierarchy. We have shareholders who will elect board of directors, who will oversee management and executive officers. Okay, so when it comes to shareholders' voting rights, they're the ones, as we said, to be electing these board members. So how do we determine how many voting rights each shareholder will have? So on the exam, there are generally two possible situations that you might or might not see. We have a statutory voting situation and a cumulative voting situation. Okay, so statutory voting, which by the way is just a detailed term, this can also be thought of as your general rule. Okay, and essentially what this is indicating is that each shareholder will have one vote per board of directors, right? So if Becky, Stacy, and Rhonda's hair studio exploded and they went public, and let's say that Hair Capital stock was diluted down to 1%, that would mean that when it comes to voting for the board of directors, they would only have 1% of the votes for, let's say, 6 total board of directors. Whereas cumulative voting is essentially when shareholders are going to come together and join forces and essentially pool their votes cumulatively. All right, so let's say, for example, again, there are 6 board members that are being elected. And again, Hair Capital only makes up 1% of the common shares outstanding. So in this case, they're going to be able to vote 6 times, 1 for each candidate. But if they decide that they want to pool their votes together and allocate them all to one candidate, effectively they would be voting 6% of their total shares for one candidate. Okay, so essentially they could pull all their votes together and give this to one person instead of spreading them out. Okay, or they could do something like 3 to one candidate, 3 to another candidate, however they want to do it. But long story short, this is going to allow a small fish to have a greater presence when it comes to voting for the company's board of directors. All right, so those are voting rights. How about dividend distributions, right? Shareholders will be entitled to dividends. That's kind of the whole point of getting a return on investment. So again, we're not only talking about legal duties and obligations that the company will have. We're also talking about rights that the company's partners, the members of an LLC, or in this case, shareholders of a corporation will also have. So when will a shareholder have rights to a dividend? Right, remember, hint, hint, entity taxation. We're talking about when C corporations are making distributions from current earnings and profits and accumulated earnings and profits. If we're talking about an S corporation, this would be when those distributions were made from the AAA account, or in some cases, when they have accumulated C Corp E&P. Regardless, we want to know on a conceptual level, when can this dividend be distributed? And the answer is when the board of directors say so. Okay, so only the board of directors can declare dividends. It is at this point that the shareholders' equity that they are entitled to will be reduced. Okay, so let's think about the different types of stock. Well, shareholders can either be shareholders of, as we said, a C Corp or an S Corp. Okay, so what you need to note is that S corporations can only have one class of stock, meaning S Corps won't have both preferred stock and common stock. Okay, so we talked about that when we determined the eligibility requirements of an S corporation. All right, if you have no idea what I'm talking about, go back to the previous chapter that talks about the formation of an S Corp. So as we said, if this is a C Corp, there might be more than one class of stock. So let's say that we have both common stock and preferred stock. Preferred stockholders are those who are entitled to a dividend before common stockholders, right? They are preferred, as the name suggests. Okay, so what do they have preference on? That's the dividend distribution. And on top of that, there are 2 types of preferred stock that you should generally be familiar with. We have cumulative preferred stock and non-cumulative preferred stock. If you're a preferred shareholder, you're hoping for cumulative preferred stock, because what that means is if the corporation decides not to distribute the dividend in the current year, the amount of that dividend will still accumulate and will be paid out in future years. If it doesn't accumulate, well, that's tough news for the preferred shareholder, because that means that the dividend that the corporation that they decided not to distribute in the current year is a preferred dividend that they're not ever going to see. Okay, it wouldn't have accumulated for all intents and purposes. Okay, so hence the word non-cumulative preferred stock. Okay, so another option is for a C corporation to distribute stock dividends. In this case, this is the company issuing more stock. So we talked about this briefly in prior modules, and we know that this is also an option. Okay, so what other rights do shareholders have? So something that the exam will randomly sneak in there is that shareholders will have the rights to inspect the company's books and records. If the company wants to basically audit the company, they could do so, but only if they have a written notice stating that the purpose of the audit or the review of the books and records is for relevant purposes. So remember, shareholders will have the right to inspect the company's books and records, but upon 5 days written notice. And this could be the shareholder themselves, it could be the shareholder's attorney, or it could be the CPA of the shareholder. Okay, now let's do a quick recap and go through our clues to success. Right? Remember, business structures can be a little bit arcane, it can be a little bit miscellaneous in the grand scheme of things, but that doesn't mean that it's not important. Right? You could very easily see questions related to any of these business structures on the exam. All right, so if we stick to our mental map and we know at a high level the 4 elements that they are targeting these question types on, it's going to make your life a whole lot easier. All right, so when it comes to formation, we remember 3 types of business structures will not require filing with the state. Okay, so we want to focus on who files with the state in a formation type question when it comes to business structures. Sole proprietorships, general partnerships, and joint ventures will not require filing with the state. Every other business structure will. Okay, so period, end of story. If you're going to memorize, do it this way. Start with the shorter list. When we think about our names of entity owners, this is going to feel a lot more intuitive. The one type of owner that we want to focus our attention on that might sound a little bit different is those of LLCs. Okay, so it's pretty intuitive to think that a sole proprietor would be the name of the owner of a sole proprietorship. We can naturally think that partners are the owners of partnerships, shareholders are the owners of a corporation. But something sneaky that the exam has thrown candidates is that a member is the name of the owner of a limited liability company. All right, so remember the sneak attack. Members are going to be associated with LLCs. And finally, when would the owner, right, that could be a shareholder, could be a partner, could even be a member. When would they be liable? And when I say that, I mean, when could they come after their personal assets to pay off this debt? Okay, so the general rule is that limited liability partnerships, right, LLPs, limited liability companies, those LLCs, and both types of corporations will have limited owner liability. Right? That's the beauty of these entities sometimes, is that they cannot come after the owner's personal assets if they default on this debt or obligation. Okay, so one of the sneaky ones to note is limited partnerships. When we think about limited partnerships, we're thinking at least one general partner and at least one limited partner, always. The general partner is the operator, right? That's Becky. And the limited partner is the passive investor. Okay, that's Hare Capital. And what we need to remember is that only the general partner, only Becky, would be personally liable in this entity. Okay, so that's what we got to know at a high level when it comes to business structures under business law. Let's know this, let's get these easy questions right, and let's move on.